Hello and welcome to our Q3 investment update. My name's Jordan Gillis and I'm one of the partners here at Saltus, and I'm joined today by Michael Stimpson, who's a member of our investment team and is going to run through the update with me. So Mike, do you want to give us a little bit about what you do at Saltus?
Sure. I'm Mike. I sit on our investment committee, which means I'm part of the team that manages the portfolios for Saltus clients.
Okay, great. And as we sit here today, we feel like we're at a bit of a crunch point really, with global politics heating up and COVID rearing its head once again. And for those of you that watched our previous investment update, you may recall that we finished by saying that we were cautiously optimistic. This was largely due to the level of government fiscal support that was occurring and asset prices increasing as a result. So, Mike, has this come to fruition? What's been happening over the quarter?
So I think it largely has, Jordan. We've had lots of central bank and government support. We had, lockdown restrictions ease over the summer, and that has led to sort of asset prices going up. So as we sit here today, at the end of the third quarter, investors have had a good period of returns. I think there have been a couple of other structural things that have happened, which are quite important. The first is that the European Union has recognised that it needs some form of common debt to underpin its 750 billion euro rescue package.
Okay, and what does that mean for Europe though, really?
It could be the start of a common fiscal policy around Europe to sort of partner with the common monetary policy that they already have.
So is this the beginning of the sort of federal United States of Europe, if you like?
It's very early days, but this is what some people are starting to wonder. And if that is the case, if we do finally have a single fiscal policy to complement the monetary policy, it could be a real game changer for investment in Europe. The other thing that's happened is that in the US, the Federal Reserve has moved to average inflation targeting, which again doesn't sound like a big deal, but after many years of running below the inflation target, it signals that the economy may be allowed to sort of heat up and grow quite quickly, even if it means that inflation goes up a bit, which potentially again could be really good for investors.
Okay, so signals of perhaps significant change in Europe and the largest economy in the world being allowed to perhaps overrun slightly all sounds pretty positive. Are we putting the foot on the pedal and adding risk then at the moment?
We've largely been at risk in portfolios over the summer, which has been beneficial as equities in particular have performed really well. As we came into September, there was some profit taking more generally, particularly in some of the large US technology companies that had done so well. And in portfolios, we've largely followed suit. So we've actually taken a little bit of risk off the table more recently as we sort of look ahead to what could potentially be a sort of slightly more difficult period.
And is that profit taking a reflection of what we're all seeing on the TV at the moment? We saw a pretty lively presidential debate a few days ago. Boris has been back on the TV and it's all looking a little bit concerning again. So is it a sign of genuine economic troubles or short-term noise?
I think that's $1 million question, Jordan. There are three things sort of currently top of our worry list. The first is COVID and infection rates and also a potential vaccine coming down the road. The second is Brexit, trade deal or no deal. And the third, as you've just alluded to, is the presidential election and the potential for not having a smooth transition of power. All three of those things could either be very positive or very negative for investors. And given that they're all quite binary outcomes, we'd rather just sort of take a step back and sort of wait and see how they play out rather than sort of trying to guess what's going to happen.
Okay, so if I was going to try and summarise that for people, really, we remain positive in the longer term because of some interesting macro changes that have occurred. However, we've decided to really pause and take stock at the moment because of some of these short-term events on the horizon so that we can react quickly if we need to.
Yeah, I think that's exactly right. We've allowed cash to build a little bit in portfolios. And the nice thing about that is it gives us some dry powder so that as these events unfold over the coming sort of weeks and months, we can be ready to move quickly and take advantage of opportunities as they arise.
Well, it certainly will be interesting to see how they develop. That's it from us today. Thank you so much for joining us, and hopefully we'll see you at our next investment update.